Peter Lynch achieved a 29% yearly return when he managed the Magellan Fund at Fidelity. He is one of the greatest investors of all time. In the book One Up on Wall Street, he teaches us how to pick stocks and how to make better investment decisions. Hi, welcome to The Holder Investor. In this video, we will go over the top 5 lessons from the book One Up on Wall Street by Peter Lynch. The first lesson is to pick the winner's stocks. Peter Lynch always looks for what he calls 10-baggers, which are stocks that can multiply your investment 10 times. You don't need to find a revolutionary tech company to have a 10 times return. You can find 10-baggers in simple businesses like Monster's Beverage, for example, that had a 10 times return in the last 12 years. Their business is pretty simple. They make energy drinks, and they had a fantastic performance. But how does Peter Lynch find companies that have the potential to be a 10-bagger? The first thing is to understand the basic business of the company. The simpler it is, the better. When somebody says any idiot could run this joint, that's a plus because, sooner or later, any idiot probably is going to be running it. Although it's easy to forget sometimes, a share of stock is not a lottery ticket. It's part ownership of a business, so you should focus on understanding the business. What will make the stock go up in the long run is the capacity of the company to increase its earnings. In the long run, the stock price will follow the earnings. Before buying a stock, Peter Lynch likes to be able to give a 2-minute monologue that covers the reasons he is interested in it, what has to happen for the company to succeed, and the pitfalls that stand in its path. This is the story of the company. You should create a story that even a child could understand. Then you have a proper grasp of the situation. The second lesson is the categories of stocks. Peter Lynch divides stocks into 6 categories. Let's check out what he looks for in each one. The first one is slow growers. Usually, these large and aging companies are expected to grow slightly faster than the gross national product. Slow growers didn't start that way. They started as fast growers and eventually pooped out, either because they had gone as far as they could, or else they got too tired to make the most of their chances. Slow growers are low risk, low gain because they're not expected to do much, and the stocks are usually priced accordingly. The second is stalwarts. Stalwarts are not exactly agile climbers, but they're faster than slow growers. When you traffic in stalwarts, you're more or less in the foothills, 10 to 12% annual growth in earnings. Some examples of stalwarts include Coca-Cola, KO, Colgate-Palmolive, CL, and Procter & Gamble, PG. Stalwarts are low risk and moderate gain, so Peter Lynch always keeps some stalwarts in his portfolio because they offer pretty good protection during recessions and hard times. The third is fast growers. This is one of Peter Lynch's favorite, small, aggressive new enterprises that grow at 20 to 25% a year. If you choose wisely, this is the land of the 10 to 40 baggers and even the 200 baggers. A fast-growing company doesn't necessarily have to belong to a fast-growing industry. For example, Nike had a 20 times return in the last 20 years by making shoes and clothes. There's plenty of risk in fast growers, especially in the younger companies that tend to be underfinanced. Peter Lynch looks for fast growers that have good balance sheets and are making substantial profits. For fast growers, you should investigate whether the product that's supposed to enrich the company is a major part of the company's business, what the growth rate in earnings has been in recent years, and if the company still has room to grow, and whether the expansion is speeding up. The fourth is cyclicals. A cyclical is a company whose sales and profits rise and fall in a regular, if not completely predictable fashion. In a growth industry, business just keeps expanding, but in a cyclical industry, it expands and contracts, then expands and contracts again. The autos and the airlines, the tire companies, steel companies, and chemical companies are all cyclical. Cyclicals may be low risk and high gain, or high risk and low gain, depending on how adept you are at anticipating cycles. If you are right, you can get your 10-baggers here, and if you are wrong, you can lose 80 to 90%. The fifth is asset plays. An asset play is any company that's sitting on something valuable that you know about, but that the Wall Street crowd has overlooked. With so many analysts and corporate raiders snooping around, it doesn't seem possible that there are any assets that Wall Street hasn't noticed, but sometimes there are. The asset may be as simple as a pile of cash. Sometimes it's real estate and even patented drugs. Asset plays are low risk and high gain if you're sure of the value of the assets. If you are wrong on an asset play, you probably won't lose much. And if you are right, you could make a double, a triple, or perhaps a five-bagger. The sixth is turnarounds. These aren't slow growers. These are no-growers. These are potential fatalities. The turnaround is akin to a restructuring process where the entity converts the period of loss into one of profitability and success while stabilizing its future. As the company is a potential failure, the market will price that. And if it turns out that the company improves, it could result in a 10-bagger. These are high risk and high gain. For turnarounds, the most important thing is to check if the company can survive a raid by its creditors. How much cash does the company have, and how much debt? How is the company supposed to be turning around? The third lesson is designing a portfolio. In designing a portfolio, you may think about how many stocks to own. For Peter Lynch, you should own as many stocks as there are situations in which A. You've got an edge, and B. You've uncovered an exciting prospect that passes all the tests of research. Maybe that's a single stock, or maybe it's a dozen stocks. There's no use diversifying into unknown companies just for the sake of diversity. A foolish diversity is the hobgoblin of small investors. That said, it isn't safe to own just one stock because, despite your best efforts, the one you choose might be the victim of unforeseen circumstances. If you are looking for 10-baggers, the more stocks you own, the more likely that one of them will become a 10-bagger. Among several fast growers that exhibit promising characteristics, the one that actually goes the furthest may be a surprise. A common mistake people make in their portfolio management is to sell the winners and hold on to their losers, which is about as sensible as pulling out the flowers and watering the weeds. Others automatically sell their losers and hold on to their winners, which doesn't work out much better. Both strategies fail because they're tied to the current movement of the stock price as an indicator of the company's fundamental value. The current stock price tells us absolutely nothing about the prospects of a company, and it occasionally moves in the opposite direction of the fundamentals. A better strategy is to rotate in and out of stocks dependent on what has happened to the price as it relates to the story. A price drop in a good stock is only a tragedy if you sell at that price and never buy more. To Peter Lynch, a price drop is an opportunity to load up on bargains from among your worst performers and your laggards that show promise. The fourth lesson is individual investor can beat pros. For Peter Lynch, professional investors have many disadvantages over individual investors. Let's check some of them. The company size. A huge fund cannot invest in a stock that is too small, as it will not have a significant impact. Regulation. Whenever fund managers decide to buy something exciting, against all the social and political obstacles, they may be held back by various written rules and regulations. Capital is dependent on clients. The manager is investing other people's money, and these people tend to get back their money in bear markets and put more during bulls. This is the opposite of what you should do. The individual investor does not need to have these concerns. The fifth lesson is the 12 silliest and most dangerous things people say about stock. The first thing people say is if it's gone down this much already, it can't go much lower. There's simply no rule that tells you how low a stock can go in principle. If the company is performing poorly and continues to lose earnings, it can continue to go down. The second is you can always tell when a stock's hit bottom. Trying to catch the bottom of a falling stock is like trying to catch a falling knife. It's normally a good idea to wait until the knife hits the ground and sticks, then vibrates for a while and settles down before you try to grab it. The third is, if it's gone this high already, how can it possibly go higher? The point is, there's no arbitrary limit to how high a stock can go, and if the earnings continue to improve and the fundamentals haven't changed, can't go much higher is a terrible reason to snub a stock. Shame on all those experts who advise clients to sell automatically after they double their money. You'll never get a 10-bagger doing that. The fourth is, it's only $3 a share. What can I lose? Whether a stock costs $50 a share or $1 a share, if it goes to zero, you still lose everything. The fifth is eventually they always come back. Many stocks lose their fundamentals and never come back. The sixth is it's always darkest before the dawn. There's a very human tendency to believe that things that have gotten a little bad can't get any worse. Sometimes it's always darkest before dawn, but then again, other times it's always darkest before pitch black. The seventh is when it rebounds to $10, I'll sell. Whenever you're tempted to fall for this one, remind yourself that unless you are confident enough in the company to buy more shares, you want to be selling immediately. The eighth is conservative stocks don't fluctuate much. Companies are dynamic and prospects change. There simply isn't a stock you can own that you can afford to ignore. The ninth is it's taking too long for anything to ever happen. If you give up on a stock because you're tired of waiting for something wonderful to happen, then something wonderful will begin to happen the day after you get rid of it. It takes remarkable patience to hold on to a stock in a company that excites you but that everybody else seems to ignore. You begin to think everybody else is right and you are wrong. But where the fundamentals are promising, patience is often rewarded. The 10th is, look at all the money I've lost. I didn't buy it. We'd all be much richer today if we'd put all our money into Amazon at $2 a share. Regarding somebody else's gains as your own personal losses is not a productive attitude for investing in the stock market. In fact, it can only lead to total madness. The 11th is, I missed that one, I'll catch the next one. The trouble is, the next one rarely works. The companies are different from each other. You should analyze the company by what it is and not by if it could be the next something. The 12th is, the stock's gone up, so I must be right, or the stock's gone down, so I must be wrong. When people say, look, in 2 months it's up 20%, so I really picked a winner, or terrible, in 2 months it's down 20%, so I really picked a loser, they're confusing prices with prospects. Unless they are short-term traders who are looking for 20% gains, the short-term fanfare means absolutely nothing. As Peter Lynch, Charlie Munger is also one of the greatest investors of all time. In the book Charlie Munger, The Complete Investor, we can learn how Charlie Munger invests. You can watch the top 5 lessons from the book by clicking on the card on the screen. If you like this video, please hit the like button and subscribe to receive more videos about investing. Bye!